Today is the big one. You've been asking for it for months. It has been in news headlines forever. And the data suggests that it's not as bad as the media makes out. And of course, the analysts make out as well. We're going to dive into two massive historic charts that suggest that the markets in 2024 are not going to be as bad as the media is anticipating. And we're going to look at some major narratives that are suggesting that we are going to go into a recession in 2024. And of course, I want to unpack the data around these particular points. And of course, as we bring all this data together, let's have a look at what may happen in late 2024 and how crypto will explode, and looking at history when it has exploded from this point. And there's a lot of big claims that I'm making in this video, but we're just going to look at the data, stick to the facts, and see what happens in 2024 to see if history rhymes according to the past. Hit the like and subscribe button. It is your home of macro cycle analysis, studying the past to forecast the future, and we cover crypto, the stock markets, Bitcoin, the real estate cycles, and of course, commodities as well. Guys, links in the top of the video description for TIA Premium. And if you subscribe to the free investor report, you'll get an email that lets you into the Discord community, and you can read about TIA Premium from our members telling us about the course itself, telling us how it's changed their life. You'll also see reviews on the courses themselves and how the course has changed people's investing and their trading, whether you're short-term or long-term, just trying to figure out the markets, or you really want to get stuck into some of that short-term trading. All you have to do is click that link in the top of the video description right here, subscribe to the free TIA report. You'll get the email and a link to join Discord so you can review all of the TIA reviews. Guys, let's kick it off with the first bit of data. And the data I'm looking at here is basically the panic phase. S&P 500 after the panic phase of typical sentiment cycling from plus 0.6 to negative 0.6. Anyway, the main thing here is that there are 10 signals, and after these particular signals, 6 to 12 months later, you typically get a positive result on the S&P 500. So before we have a look at the data below, let's have a look at what this is exactly. You can see we've got the panic line up here, and then basically the opposite to panic, I guess the calm in the storm as the market continues up. And essentially all this is looking at is a flip from panic to, let's call it calm, within 30 days. So a really fast flick from panic to not panic, and what typically happens after those periods. Now we looked at 6 months, not a great reading. 3 months, not a great reading either. You're just looking at roughly 60%. But 12 months later, 80% of the time, the market has been positive. This goes back all the way to the Great Depression, 1928. You can see a few readings back here in 1932, 1933, 1935. Then again in the 40s, you got one in the 50s, 70s, a few in the 80s, and then our current reading here in 2023. So they're pretty well spread out over the course of 100 years. But remember, this is a really fast move from extreme pessimism to extreme optimism. That's within 30 days. So if you could bring this reading back to say, well, what if it happened in less than 45 days or 60 days, and you'll get a few more data points here. But this one is looking at the extremes, going from extreme pessimism to extreme optimism within 30 days. So basically their panic sentiment cycle here. And over those 12 months, well, 80% of the time the markets have been higher, with a median result here of around 15%, average max gain 22%. Meaning that possibly over 2024, we might have a pullback as we've been looking at on the channel. But at the end of the 12 months, that last quarter of 2024, potentially 8 out of 10 times, we'll see positive results here. A maximum they've seen in the past is roughly 22% from when the signal occurred. And this signal occurred on the solstice, 21st of December. So let's look forward 12 months to the next solstice, 2024, just before Christmas time. Let's see if the markets can heat up and give us 15 to 22% from the current prices. So that's our first piece of data there, just looking at the panic into that sort of greed stage, or at least less panic. Now the big one, the yield curve. You may have seen this before and you guys have asked about it many, many times. So let's remember how the news headlines happen. They start to tell us this news when the yield curve inverts. So when it goes underneath the zero line here. Then they bang on about it for months upon months upon months, fearing everyone out of the markets. You guys know exactly what has happened to the markets in the last 12 months, basically a huge skyrocketing move to the upside. Then they keep fearing the market again as the yield curve uninverts, only to see that there is still more time after the yield curve uninverts until you get a recession. Now, even in the recession, the market has already been down. So there's already signals to show you that the market is down. Is that occurring now? It doesn't seem like it. So even if this does uninvert, we have to watch the chart to figure out what happens with the market. Remember, our money is in the markets. It's not on this yield curve inversion or uninversion. So here is the big piece of data. That's basically what everyone looks at. And we know from history that the narrative is when the yield curve inverts, we're going to see a recession. When the yield curve uninverts, we're going to see a recession. But they always fail to tell you how long that can take. Some of the data shows that it could be up to 4 years that you could wait until you see a recession. And if that's the case, well, maybe we have that period now. Maybe we are in that and we have a few more years to go until we see the recession. So I'm not saying there won't be a recession. I'm just saying the timing is always off, especially when we just listen to news headlines. So let's have a look at the data here that has been put together by Sentiment Trader. Fantastic stuff here. These guys are always producing really, really good data. So looking at the S&P 500 performance following initial inversion, well, you can see the S&P over the next 12 months has had positives and negatives, but typically it is leaning more to the positive side here. So as it says here, the results in the table are neither uniformly bullish nor uniformly bearish. So all we hear is that the market is going to collapse. We're going to see recessions. Watch the yield curve invert, then uninvert, then wait. And essentially the data shows that it's not bullish nor bearish. But if you had to lean to one side, there's typically, they skew to the positive side if we're looking just 12 months ahead. So the sky is falling narrative is not borne out. The table below summarizes the results from the above table. 16 up, 8 down. Number of times that the market's done greater than 10%, 15, and then down to the downside, 1. Now, what about the uninversion? The S&P 500 performance following initial uninversion, because remember, there has been times where it has inverted, then uninverted, then inverted, then uninverted, then inverted, then uninverted. So it's not an absolute science here. It's not absolutely clean. However, looking at this here, when it initially uninverts, S&P over the next 12 months, positives, negatives, lots of positives, one negative here, lots of positives, many negatives here, all coming from that 2007 period, and then the one that we got here in 2022, just late last year, or middle of last year there. So once again, the results on the table above are neither uniformly bullish nor uniformly bearish, although they do skew to the positive side. So the way I read that is we really must stick to the data and avoid all of the news headlines. I think this is going to be a massive one in the coming years, 2024, 2025, maybe even into 2026. This chart will continue to come up because, of course, the yield curve has been inverted for quite some time. And then maybe when this uninverts, we'll start to hear more and more about how we should see a recession soon. Meanwhile, depending on where we are in the cycle, the markets could continue up from that point. Look at what happened back in the 80s. There was a recession, but the yield curve inverted again, then uninverted. Then you had another recession here in the early 80s. You got 1982s, and then it remained above, and then again inverted, uninverted. Then you had to wait a period of time. So pay particular attention to the data is what I'm saying here. Avoid the news headlines for what they are, and just stick to the charts. A great point to finish up on the yield curve. If you're ever looking at the yield curve, you're hearing those signals in 2 months, 6 months, 12 months, come back to this particular video, bookmark it, save it somewhere, put it on your watch list, whatever you got to do. A nice answer here, a nice finish from the author. So have we debunked the notion that the inverted yield curve provides a warning sign? Not really, because sometimes it does. So let's be clear about the implications. This message is not that investors should ignore the state of the yield either now or anytime in the future. The real point is understanding that the yield curve is only one factor that may affect the stock market. So it's simply just looking at one thing, and what the media and other analysts try to do is tell us this one thing is going to be our savior, our holy grail to tell us that the market is going to collapse. And we all should understand that there is no one holy grail in the market. There are many factors coming together. This last line here, one key to long-term investment success is to avoid self-inflicted wounds. I love this one here. If you shoot yourself in the foot, it's hard to take the next step. So if you shoot yourself in the foot, trying to figure out a holy grail like this, it's going to be very, very difficult to take that next step. And as many investors have done over the last 1 to 2 years, well, they have expected the markets to collapse. Meanwhile, the last 14 months or so, they've missed out on an epic rally. Switching from an epic rally into an epic decline, the US dollar. This one's important for our markets going into 2024 and this second half of the real estate cycle. We've suggested that the US dollar is going to continue to collapse. So far, it's done just that. It has had a rebound early this year, came right into the 50%. Can you see that? Can you imagine how beautiful? Gann got this thing back over 100 years ago to figure out that markets are attracted to 50% levels. It blows my mind all the time. No computers, nothing like that whatsoever to figure out this fantastic tool here. The 50%, super simple to use on your extreme levels. Now that I finished that rant, having a look at the 50%, major double top, hit that, got rejected. Market has been down from that point. Using our Gann swing indicator, you can see that the trend is well and truly down. Lower highs, lower lows. Swing indicator, top of the video description, 7-day free trial, something that we use for all of our trading and investing across any time frame. It's really, really easy to use. Now, we're about 1.5% from putting in a new low here after that peak in 2022. That would bring us out to about a 91-week low. So coming up to about a 2-year low here for the US dollar. Now, of course, it needs to get there. We've got a 1.5% move to go from where it currently is to break 99. I suspect it'll happen over the coming months. This is something to watch because the weakness in the US dollar is obviously going to help out the stock markets, going to help out cryptos, and of course, it's going to help out Bitcoin. Now, if that wasn't enough, I've got another extremely massive cycle that we are watching into 2024. It has helped us out fantastically well in 2022 and in 2023. 2024 is going to be the big one. It is the 4-year presidential cycle. Now, looking at the S&P 500, it's given us a few little clues here. We can see that after the election, or just around that election point, you can see the market typically has a little bit of a pullback into the election. But what's going to get really interesting is looking at this and how it applies, or at least we can overlay it on top of the Bitcoin chart, and for cryptos to explode, using the terminology that the cool kids like to use in their titles and all that sort of jazz. What we're looking at here is, of course, the election year coming up in 2024, because we just had the pre-election year, which typically shows extreme upside. Now, this extreme upside is in the 3rd year, so year 3, that's the year we've gone through. In year 4, it typically isn't as large, but there is still an upside for that 4th year. Now, of course, it's not always going to repeat exactly the same, because we can see the 2nd year also had a positive return of 4.5%, but what we actually saw in the 2nd year itself here, so 2022, is we saw a negative year of roughly 25%. So we had that down year coming into the market, but it was a correction because, well, now we can see the market has reached higher prices from that point. So we use this to understand where the cycle might head. Of course, I'm not saying that it has to happen exactly like this, but it's interesting to point out that this has been data from roughly 1928, and this is typically the cycle that the market follows. So the 3rd year has been the best year, and the 4th year isn't as good as the 3rd year, but it's gains, so who's complaining? What I've done here is just break down the previous 2.5 years leading into that election to see if we've got any sort of similarities to the current market structure and what we could expect into 2024. So just putting it reasonably simply, the breakout point is basically where I ended the monthly count. You can see here the breakout point there happened to be on the Bitcoin halving. The Bitcoin halving happened just slightly earlier than the breakout point before the election. And then going back to a significant point in the market top, so the market top for the S&P, which also roughly coincides with the top for the Bitcoin cycle itself. Because like we've seen with the accumulation chart, which I believe is this one here, you've got the period of Bitcoin accumulation before the market just goes into a massive bull market. Now, it doesn't look like much on this chart here, but of course, Bitcoin in 2017 just skyrocketed. And for the S&P, there was basically no pullbacks in that period. And if there are pullbacks like we had in 2021, they're all higher lows and just very, very shallow pullbacks before you finally get that top. And then, of course, the market corrects from there. So heading back to this chart here, just looking at that 2.5-year period from those peaks, there's been some significant pullbacks just before we get to that election. So you got the Bitcoin halving, you got the election, you got the breakout, and the market sort of dipping into the election before the market goes absolutely chaotic after that election. Now, I'm only looking at the period for Bitcoin's history on the S&P. So there's not that many data points. We obviously like to use far more data points than this, but let's use what we have because essentially that's the only data that we've got. So just coming back to the cycle here in 2014, 15, 16 into that 17, you can see the market had a significant pullback, 3 months. That's where my counter is here, just using the Gann swing indicator. Turn this on. Then you can filter out a number of bar counts so that you only see the significant moves in either direction. So 3 bar counts is what we're looking at here. So the market saw 3 months against the trend. We had the uptrend, we had 3 months back. Then it started to rally out of that low. The Bitcoin halving happened in that rally. Market pauses, has a little bit of a pivot, comes back for a period. This time it was 3 months again into that low of the election. And then 2016, well, the market took off from that point. Everything went chaotic. 2017, huge bull market. The cycle after that, we had another 3-month pullback after the peak, another couple of months, which was very, very significant. Obviously, the COVID pullback. Bitcoin halving happened in the market rallying to a breakout point. Then the market paused into the election. So basically 2 months before the election happens, markets go on a chaotic bull market into that final peak. So looking forward to now, where we've had a 3-month pullback, it seems like it could be a little early, but we've seen that in the past. So maybe we see that again leading into the first half of 2024. Then you've got the election later in 2024. And what we've seen from that election is basically a couple of months before it, the market just pauses and waits to see what goes on. This isn't something that is unknown. Many people know about this, many investors, funds, everything knows about the period leading up to the election. And they sort of wait to see who gets in before they start to make their plays in the market. Once that occurs, bam, things go absolutely ballistic. So if history is anything like the past, and you can even see it from the previous cycle before the market went to a new all-time high, the Bitcoin halving and the election happened at that time. Markets went ballistic after that point to break into a new all-time high after the GFC. So as I was saying, if the markets are anything like the past, we could potentially see another ridiculous, crazy, chaotic move late 2024 into 2025, because these things typically last for roughly a year from that point. You can see here that was 14 months from the election into that first peak. We take it from the 2022 top to the election, roughly there, 14 months again. We got another top. And for shits and giggles, let's have a look at the election from 2012 and go forward 14 months. Well, there it is. 13 months had your first peak, and that was the peak for Bitcoin as well. So election, 13, 14, maybe 12 to 14 months later, could potentially be that crazy bull market that brings all of the retail in. They go ballistic and degenerate onto altcoins. But for now, we're still sitting in a roughly 3-week holding pattern on BTC, holding between $41,000 and $44,000. We've had a significant move to the upside so far, 85 days from the low in September to the peak that we've just seen in early December. Should this market push higher than 45, well, then we just drag out the day count to roughly wherever that point is and review the markets from there. Now, to BTC and the election point, just so we can get a clear look at this on the Bitcoin chart. There is the election, and the coming election right here. So from each of those election points, Bitcoin has gone ballistic. So if we want to get in before that, let's have a look at some timing before things go bananas. The election in 2016 was a breakout of the 50% level, and a few months earlier was the halving. So if you got the breakout to the low, it's about 3 months before the election. You had that nice little low there. So November, 3 months earlier, is roughly August. So let's have a look at it again. Well, we know November is typically the election month, 3 months earlier. Well, there's your peak there in August and a low into September. So 2 months at that point. Let's take it back to one previous cycle. So this one here doesn't have as much data. We've got the election here and the halving in the same month. And the pullback was basically the month earlier here. You can see the red month there on October. But if you want to have a look at the peak in August, there's 3 months earlier. Well, you got the big boom and the big pullback in that particular month. That was August of 2012. Election happens, market goes ballistic from that point. We can see it again on the chart. Election happens, markets go absolutely ballistic from that point. And again, the market got a little bit of a move on just before the election, which is why I was bringing up looking at timeframes just slightly before that election, yet potentially after that halving, as we see a little bit of a pause and a pullback from the hype of the halving. From that point, markets go ballistic. So looking at the altcoin market cap, the total 3 here, this excludes Bitcoin and Ethereum. There's Bitcoin's new all-time high, which was also the November month, which was the election of 2020. Well, you can see that altcoins went absolutely ballistic. We only have one chart here, or one presidential cycle for the altcoin market because it's so fresh. Can it happen again? We've only got one data point. That's what we're betting on, right? So let's have a look at a few months prior to that. You can go back 4 months. 5 months takes us to the point where the market was just starting to break out after that COVID trap. So that was 5 months. And if we look back to the low of that COVID trap, it's roughly 8 months. So what we want to do is have a look at where the election is. So that's November, and take it back 4 to 5 up to about 8 months prior to that to see if we can get into that nice low point for the altcoins. After a potential correction, nothing has pulled back yet. We've got Ethereum going ballistic. So 4 months takes you to July, so 4 months back, and then 8 months takes us to roughly about April of 2024. Well, that's 7 months, so roughly around that March, April period as well. So leading into that late Q1, maybe early Q2 for that pullback, and probably based on the cycles we've looked at for 12 years on the S&P and Bitcoin, and then only one cycle here for the altcoins, that could be our last opportunity before the markets go absolutely nuts. This is the video to bookmark. It's the video to share with anyone that is asking about the yield curve, whether it inverts or uninverts, what happens to Bitcoin, what happens to cryptos, what happens to the stock markets in a presidential year. All of this together gives us an outlook for 2024. Remember, none of this is guaranteed. We're just having a look back on the past 12 years in this case, and for the yield curve over 40 years, and for the presidential cycle over 100 years. So hit the like and subscribe button, bookmark this, put on your watch list. I'll see you guys at the next video. And if you want to check out TIA Premium, get the link in the top of the video description here. It'll give you access to the free Discord community where you can review what our members have been saying, what they've been saying about the courses and how it's helped their trading and investing. Thanks once again, guys. I'll see you over on the channel or on Twitter as well in the next video. Until then, take care and peace out.